Welcome back. Today is tax day. And while the rest of us scramble to meet the midnight deadline for tax returns, the richest 1% of Americans will sit tight and comfortable knowing that they've gamed the system once again. A combination of subsidies and preferential privileges has transformed the IRS into one of the federal government's largest welfare programs, at least for the super rich. Just 2 years ago, ExxonMobil, the most profitable corporation in human history, raked in $7 billion from tax breaks alone. That same year, General Electric paid $0 in corporate taxes. That's right, zero, zilch. The official corporate tax rate in the United States may be 35%, but loopholes and subsidies supported and lobbied for by major corporations and very, very wealthy individuals have whittled the effective corporate tax rate down to about 12%. Tax deductions for vacation homes and yachts, meanwhile, send tens of billions of dollars annually back into the pockets of the wealthy. While oil tycoons and jet owners get their fair share of government handouts, perhaps the biggest beneficiaries of our regressively redistributionist tax system are hedge funds and their managers. Low taxes on capital gains and the carried interest loophole allow wealthy financiers like Mitt Romney to pay lower tax rates than regular working Americans just because they make their money from investments. An absurd idea when you consider the tens of millions of dollars Romney and other hedge fund managers reap in every year. Our current tax code is the modern-day version of the feudal laws of medieval Europe. Its myriad loopholes and deductions create a system of privileges that help the rich stay rich while sucking billions and billions from the Treasury and the working class every year. According to the public interest research group, tax breaks for the wealthy cost the average U.S. taxpayer about $1,000 every April. No small sum for the millions of Americans struggling to make ends meet in the worst economic downturn since the Great Depression. Of course, manipulating the IRS isn't the only way the financial elite stays on top. I'm joined now by Les Leopold, journalist and author of the new book, How to Make $1 Million an Hour, Why Hedge Funds Get Away with Siphoning Off America's Wealth. Les, welcome.
Thank you so much for having me.
What a contribution. So let's start at the beginning. How do you make $1 million an hour?
Well, I think the answer is real simple. You have to cheat. I mean, some of the cheating is legal, some of it's barely legal, and a bunch of it is flat out illegal.
Really?
You don't make that kind of money in a hedge fund, which is an investment fund for the super rich, unless you know the outcome of the race before you run the race. Nobody puts this kind of money on the line unless they're pretty sure they're going to win their bets. So when I got involved in doing this research about hedge funds, because I noticed that their incomes were absolutely outrageous. I found out that the top hedge fund guy made as much in 1 hour as the average family made in 47 years.
Whoa.
Think about that. 1 hour equals 47 years. How do they do that? What value do they create for the economy by doing that? And it turns out the answer is almost no value. It's what economists call an economic rent. The rest of it would call it a ripoff.
Yeah.
And it's just it blew my mind entirely when I started to see what they did.
I remember when hedge funds became, you started reading about them in the New York Times and the Wall Street Journal and whatnot. It was maybe 15 years ago, 20 years ago, and it was this kind of this new thing, maybe even a little before that. And you really had to be a millionaire to even put money. In fact, they had limits. I think you had to have a net worth of over $1 million, and you had to $250,000 because there was so much risk associated with it. And they were to hedge against problems in the marketplace, and you might lose. You know, there was this whole sense of this is just a protective vehicle. It's like a the rubber bumper to well, I'm missing a metaphor here, but how did they go? Well, first of all, were they ever that? And if so, how did they go from being basically protective devices or safety valves for investors to being money machines?
Well, they may have been about hedging back in the 60s. Way at the beginning, but by the period you're talking about is when we deregulated finance, and when we deregulated finance, the money that flowed up to the top 1% was enormous. It stopped going to working people, it went to the 1%. So there was a huge amount of money to play with. And these guys came around and said, hey, Give me your money, I will play with it, and you're going to make a fortune. And they came up with a lot of ways to make a fortune that involved insider trading, now high-frequency trading, which is, strikes me as something that should be illegal, but it's barely legal in my opinion. But they came up with ways to bet and win the bet. Let me give you one example that blew my mind. By the way, the proprietary trading desks inside of the big banks, they're hedge funds too. And they invest in hedge funds. So there's a kind of a symbiosis between the hedge funds and the large banks. Here's an example. You might have heard of the famous abacus trade. It was about designing a housing security. It was designed by a hedge fund so that it would fail, so that hedge fund could collect an insurance policy on that security.
So they could bet on its failure and make more on the bet than they made on the failure.
Right, but they designed it as well. It's like you could go out and sell a house that's going to burn down in 6 months, and you're holding the insurance policy. You, the seller, is holding the insurance policy.
And you make sure that the insurance policy is worth more than the house.
Absolutely. Yeah. And one hedge fund guy made $1 billion doing this. With a B. And Goldman Sachs got caught because they didn't tell the investors that, by the way, the guy designed it to fail. Goldman Sachs had to pay a $550 million fine. Guess how much the hedge fund guy had to pay? Guess.
Zero.
Zero.
Yeah.
Because he didn't have to disclose. So he was in cahoots with the big bank. And
Goldman Sachs paid $500 million, you said?
$550.
But over $1 billion was made on this deal.
By the hedge fund guy.
So this is just like a cost of doing business.
You don't make this kind of money unless you are very, very sure you're going to win the bet. Take high-frequency trading. It's done in nanoseconds. By the time you press the button on your E-Trade account, there is a hedge fund that bought the share and sold it back to you and made a few pennies profit because they can see you coming. They're working in a different time universe. They're working in nanoseconds. You're working in seconds, minutes. Yeah. There's a guy who's doing this who bragged to the press that over the last 5 years, he hadn't had a losing day in 5 years. And the longest he ever held a stock was for the longest, 2 seconds.
Wow.
So there's half or more of all the trades in the stock market are these high-frequency traders holding it for less than 2 seconds.
We used to make things in this country.
Correct.
Adam Smith, Wealth of Nations, 1776. His whole point was that the wealth of a nation is what it makes. The example that he used was a tree limb on the ground has no intrinsic value other than perhaps to nature. But if you apply human labor to it and carve it into an axe handle, you now have something that has wealth, and that becomes part of the wealth of the nation, at least for the couple of generations until it, deteriorates. And we used to make things in this country, and finance used to be this boring green eye shade, banker's hours. The banker lived in the middle-class neighborhoods. What happened?
Once we took our foot off the neck of Wall Street, it became a gigantic casino again.
Now, was this, are you talking about 99 and 2000, the Commodities Futures Modernization Act?
Yeah, no, but it actually starts earlier. It starts in the late 70s with Carter. It proceeds during Reagan. It accelerates during the Clinton administration, and then all the things that you discussed.
Right.
That created the ability for these hedge funds and the large banks to go wild. Now, think about this. Apple, in 2010, made about $20 billion. A hedge fund with Apple had 700,000 employees around the world and contractors.
And actually made products.
Right, that we like. A hedge fund made exactly the same amount with less than 100 employees. How do you do that? How do you do that? You take, you don't make. Right. The true takers, the people who are siphoning off our wealth, are these hedge funds right now. We don't even know, they're working in the shadows. We don't even know they exist. They're stretching the whole income level. The distribution of income in the United States is being stretched way out of proportion by these guys. They make, I estimated the top 10 hedge fund guys make 40 times as much as the top 10 movie stars.
Wow.
And what they do for the economy is virtually zilch, as far as I can tell. You know, Jim Cramer, the guy from Mad Money, he actually confessed. He ran a hedge fund for 10 years, and then 10 years later, he actually confessed on a website. And he said that everything he did was fiction. He used to manipulate his fellow reporters on CNBC by giving them false tips so his hedge fund could make bets based on the false tips.
Whoa.
He said, if you are not willing...
Why is he not in jail?
Because it was 10 years later. Statute of limitations. And he said, if you're not willing to do these things, you should not be in the hedge fund business.
Well, then why, you know, if this is putting our economy at risk, it's siphoning money out of the middle class, it's creating huge economic distortions. I mean, wealth inequality in the United States is among the worst in the world now, whereas, you know, when Reagan came into office, we were pretty reasonable. In the minute we have left here, is anybody going to do anything about this? Are there any serious efforts? Elizabeth Warren, I know, talks about this.
Well, you know, we had a chance during the Occupy Wall Street period. Had that turned into a sustained populist movement, I think we could have gone after these guys. You know, the California Nurses Association, National Nurses United, is pushing the financial transaction tax, the Robin Hood tax. That's critically important for this because these folks are extracting a hidden tax from us. If we had a tax on their rapid sales of stocks and bonds, we could have free higher education in this country.
And that stat tax we had in the United States from, I think it was 1898 until 1964, as I recall, and FDR kicked it up in '35 to pay for the SEC. If my recollection is right, it was.
Europe, 11 countries in Europe are starting to institute one of these taxes. I asked
little tiny tax on each stock.
I asked Tim Geithner's office whether he would support it. And he came up with all these, you know, they came up with these excuses about how they thought it would be inefficient and we wouldn't be able to keep up with the competition. Meanwhile, the competition is instituting them.
In other words, the billionaires, the hedge fund guys have so much money that they basically own this city.
Absolutely. And the way to get them ultimately is we're going to have to build an independent, populist, anti-elite, financial elite program and constituency. We're going to have to do it.
People up. Leslie,
thanks so much for
thanks a lot. The book, How to Make $1 Million an Hour, why hedge funds get away with siphoning off America's wealth. Thanks.
Thank you.